If you are self-employed and your retirement strategy consists of putting $7,000 into a traditional IRA each year, you are leaving serious money on the table. That $7,000 contribution limit, $8,000 if you're over 50, is designed for employees who have access to workplace retirement plans. As a business owner, you have access to plans that let you contribute $69,000, $76,500, or in some cases over $300,000 per year. Hi, I'm Aradhana Aggarwal. I am a CPA, and my goal is simple: to help everyday people understand taxes without fear, confusion, or jargon. And today I'm walking you through the retirement plan options available to self-employed individuals and small business owners. We'll cover how each plan works, the contribution limits, the pros and cons, and how to figure out which one makes the most sense for your situation. Let's start with the most common option for self-employed individuals, the SEP IRA. SEP stands for Simplified Employee Pension, and the name is accurate. It's genuinely simple to set up and administer. You can open one at most major brokerages in about 15 minutes, and there is no annual filing requirement with the IRS. The contribution limit for a SEP IRA is 25% of your net self-employment income, up to a maximum of $69,000. That's a massive jump from the $7,000 traditional IRA limit. If you are earning $200,000 in net self-employment income, you could potentially contribute $50,000 or more to a SEP IRA, all tax deductible. Here is how the math works for self-employed individuals. You take your net self-employment income, subtract half of your self-employment tax, and then multiply by 20%. That 20% is the effective rate for self-employed individuals due to how the calculations work. Even though the technical limit is 25% of compensation, it sounds complicated, but any tax software or CPA can run this calculation for you in seconds. One of the best features of the SEP IRA is the deadline flexibility. You can establish and fund a SEP IRA up until your tax filing deadline, including extensions. So if you're filing an extension until October 15th, you have until that date to open the account and make your contribution for the prior year. That gives you time to see how your year shook out financially before committing to a contribution amount. The downside of a SEP IRA shows up if you have employees. Employer contributions to a SEP must be made at the same percentage for all eligible employees. If you contribute 20% of your own compensation, you must contribute 20% of every eligible employee as well. For solo business owners, that is not an issue, but if you have a team, this can get expensive very fast. Another limitation, SEP IRAs don't allow employee elective deferrals. All contributions come from the employer side. There is no equivalent to the $23,000 employee contribution you would get in a 401k. This matters because it affects how much you can ultimately save. That brings us to the solo 401k, which is my favorite option for most self-employed individuals without full-time employees. A solo 401k, also called an individual 401k plan or self-employed 401k, is available to business owners with no employees other than a spouse. It combines employee deferrals with employer profit sharing contributions, which means significantly higher contribution potential than a SEP IRA in many cases. Here is how the contributions break down. On the employee side, you can defer up to $23,000 or $30,500 if you are 50 or older. This is the same limit that applies to employees at large companies with 401k plans. On the employer side, you can contribute up to 25% of your compensation, with combined contribution capped at $69,000 or $76,500 if you are over 50 or older. Let's compare this to the SEP IRA with an example. Say you have $100,000 in net self-employment income. With the SEP IRA, your maximum contribution would be around $18,587. That's the 20% effective rate I mentioned earlier. With a solo 401k, you could contribute $23,000 as an employee deferral plus approximately $18,587 as an employer contribution for a total of over $41,000. Same income, but more than double the contribution. The solo 401k also offers a Roth option, which SEP IRAs don't have. You can make your employee deferrals on a Roth basis, meaning you don't get a tax deduction now, but the money grows tax-free and comes out tax-free in retirement. If you expect to be in a higher tax bracket later, or you want tax diversification in retirement, this is a valuable feature. There are a couple of additional considerations with solo 401ks. First, you need to establish the plan by December 31st of the year you want to make contributions, even if you don't fund it until your tax filing deadline. So if you are thinking about 2020, also, once your plan assets exceed $250,000, you would need to file Form 5500 EZ annually with the IRS. It's a simple form, but it's an additional requirement. For most solo business owners earning over $50,000, the solo 401k beats the SEP IRA on contribution potential. Takes a bit more paperwork to set up, but the tax savings are worth it. Now let's talk about an option that many business owners don't even know exists: the Simple IRA. Simple stands for Savings Incentive Match Plan for Employees. Is designed for small businesses with 100 or fewer employees, including self-employed individuals. The contribution limits are lower than a SEP or solo 401k. So, for example, the contribution limits are lower than a SEP or solo 401k. The main benefit of a simple IRA is that it allows both employee deferrals and employer contributions similar to a 401k, but with much less administrative complexity. There is no annual IRS filing requirement, and the rules are straightforward. As the employer, you are required to either match employee contribution dollar for dollar up to 3% of compensation, or make it 2% non-elective contribution for all eligible employees regardless of whether they contribute. This makes it a good fit for small businesses that want to offer employees a retirement benefit without the complexity of a full 401k plan. The downside is the lower contribution limit. If you are a high earner looking to maximize tax deferred savings, the simple IRA caps out well below what you could achieve with the SEP or solo 401k. Is best suited for businesses with modest income or those prioritizing simplicity and employee benefits over maximum owner contributions. One important rule: you cannot have a simple IRA and another employer sponsored retirement plan in the same year. So if you are considering a simple, make sure it's the right fit before committing. Finally, let's discuss the defined benefit plan, the most powerful retirement savings vehicle available and the most complex. A defined benefit plan is essentially a personal pension. Instead of contribution limits based on a percentage of income, the limit is based on the benefit you will receive at retirement. To fund that future benefit, you may be able to contribute 100,000, 200,000, or even 300,000 or more per year, depending on your age and income. The older you are when you start the plan, the more you can contribute annually because there is less time